There's a number sitting in an account with your name on it. Maybe it's 40,000. Maybe it's 200,000. You call them miles. Or points. And you probably think about them the way you think about money in a savings account. Something you earned. Something that's yours. Something that will still be there later. Let's test that. Try to book a seat with them. A specific seat. A specific day. A specific city. Sometimes it works. Sometimes that same seat costs twice the miles it did last year. Sometimes the seat is right there on your screen, you can buy it with a credit card, but it simply isn't available with miles. Nothing broke. Nobody made a mistake. That is the system working exactly as designed. Because a mile is not money. And it was never a seat. A mile is a promise. And the company that made the promise is the same company that decides, later, what it's worth. Today we follow that promise. Where it came from. Who actually paid for it. And why the airline is so happy to give you more. Start simple. Where do miles come from? The obvious answer is that you fly, and you earn. For the money flowing through the program, that answer leaves out the larger stream. In 2020, United had to show its work. It wanted to borrow money against its loyalty program, and lenders don't hand over billions on a description. So United published a presentation about MileagePlus in more detail than airlines normally allow. Here is the number that should stop you. In 2019, 71% of MileagePlus cash flow from miles sales came from third-party partners. Not cash from United's own sale of miles. Partner sales. Companies bought them, with money. One of the buyers is a bank, the one that issues the airline's credit card. So the picture in your head is upside down. You pictured the airline thanking you for flying. What mostly happens is this. A bank buys miles from the airline. The bank pays cash. Then the bank gives those miles to you, for using its card. The airline sells miles. The bank gives them away. For most of the program's sales cash flow, partner activity mattered more than United ticket sales. Let's put numbers on it. Every figure in this section comes from United's own presentation. So treat it as United describing United, not as an independent audit. In 2019, a normal year, before the pandemic distorted everything, MileagePlus brought in about $5.3 billion in cash from selling miles. That was roughly 12% of United's total revenue. Now the part that matters more. About $1.8 billion of that was EBITDA. EBITDA is a rough measure of operating profit. That's all you need to know. And that was roughly 26% of United's adjusted EBITDA that year. So, 12% of the revenue. 26% of the profit measure. The loyalty program was punching about twice its weight. That's the shape of this business. Selling miles is lighter and cleaner than flying people. No fuel. No crews. No gates. No delays. The airline is manufacturing a currency and selling it wholesale. So why did any of this become public? Because in 2020, airlines stopped flying. Planes were parked. Revenue collapsed. Every airline needed cash, immediately. When you borrow a lot of money, the lender wants collateral. Something it can take if you don't repay. Airlines had already pledged the obvious things. Aircraft. Routes. Gates. So they pledged the loyalty programs. United completed about $6.8 billion of financing secured by MileagePlus. Delta raised $9 billion, $2.5 billion in notes due 2025, $3.5 billion due 2028, and a $3 billion term loan. That financing was secured by a first-priority interest in the SkyMiles program itself. American later did the same with AAdvantage, for about $10 billion. Across those three dated transactions, the disclosed amounts add up to roughly $25.8 billion of debt raised against loyalty programs. Sit with how strange that is. An airline owns aircraft. Aircraft are worth a great deal. And yet when these companies needed the most money they had ever raised, the asset they reached for was the list of promises they had made to their own customers, and the machinery for making more of them. The lenders looked closely, and they said yes. That tells you something. Those lenders concluded this program throws off reliable cash. And this is why 2020 still matters. It was the one moment the books were forced open. Then the window closed again. The programs did not shrink afterward. Here's the piece that reframes everything. When an airline gives you a mile, it hasn't given you anything yet. It has promised you something. And in accounting, a promise you must make good on later has a name. It's a liability. United's own filings describe it plainly. The company records its obligation for future award redemptions using a deferred revenue model. In plain words, the miles in your account sit on the airline's books as something it owes. There's a second term in there worth knowing. Breakage. Breakage is the accounting word for miles that will never be redeemed. Ever. It's a normal, disclosed part of the model. Some promises are simply never collected. Now, does any of this sound like a savings account? Here's what the program's own terms say. Miles do not constitute property of the participant, and are not transferable except as set forth herein or otherwise permitted by United. Read that again. Not your property. And on whether the rules can change. United may change the Mileage Plus program including, but not limited to, rules, regulations, travel awards and special offers or terminate the Mileage Plus program at any time and without notice. At any time. Without notice. Both of those are published by United, on United's own site. And it isn't one stray page. A separate United program carries the same shape of clause. United has the right to terminate, in whole or in part, or to change the rules, benefits, conditions of participation, in whole or in part, at any time, with or without notice. We're not accusing anyone of hiding this. It's published. You agreed to it. But look at what it means. You hold a claim. They set the price. They control the seats. They can change the rules. It is the only currency you use where the party that owes you also sets the exchange rate, and can change it after you've saved up. Imagine a bank that could quietly decide your savings now by half as much, without asking, and without giving anything back. That isn't a scandal. It's the design. It's in writing. Back to the bank. The bank buys miles with real money, then gives them to you for nothing. Nobody does that unless it brings in something bigger. So what does the bank get? It gets you to use its card. And a card makes money two main ways. First, every time you pay, the merchant receives slightly less than the sticker price. A small cut moves through the payment system. If you saw our first episode, that's the same machinery, the part of the transaction nobody at the counter ever sees. Second, if you carry a balance, you pay interest. That one is much larger. Now trace the whole loop. The merchant absorbs a fee. And merchants set prices knowing those costs exist, which means the cost reaches everyone. Including people who pay cash and never earn a single mile. Cardholders who carry a balance pay interest. The bank takes that money and buys miles. The airline books the cash now. And you receive a promise, priced later, by the airline. At no point did anyone hand you something free. The reward was paid for. Just not visibly, and not only by you. Once you see miles as a product the airline sells, the odd behavior makes sense. Airlines are generous with miles. Sign-up bonuses. Spending bonuses. Promotions. Double miles. If a mile were cash out of their pocket, that generosity would be irrational. But issuing miles isn't a cost. It's the product. Every mile a bank buys is cash arriving today. The cost only arrives later, and only if you redeem. And some never will. That's the breakage we just talked about. So there's an incentive here worth naming plainly. The airline benefits when you earn more miles. It does not benefit equally when you spend them. Which explains the two things every long-time member notices. The balance gets easier to grow. And what that balance buys gets harder to pin down. The currency inflates. And the company that prints it also sets the prices. If this sounds like something a regulator might look at, one did. In late 2024, the U.S. Department of Transportation opened an inquiry into the rewards programs of the largest U.S. airlines. The stated concerns included devaluation of rewards people had already earned, pricing that's hard to predict, and effects on competition. Around the same time, a bill was introduced in the U.S. Senate aimed at limiting an airline's ability to cut the value of points without notice. Now we're going to do something unusual for this kind of video. We're going to tell you what we don't know. An inquiry was opened. A bill was introduced. Those are facts. We could not confirm what happened to either since. Bills are introduced constantly and most go nowhere. Inquiries can quietly end without a finding. We're telling you the question was formally raised. We are not telling you it was answered. If we find the outcome, it goes in the description and in a follow-up. What we can see is what the programs did in the meantime. In March 2026, a consultancy that ranks loyalty programs published its annual estimates. It valued Delta's SkyMiles at roughly $32 billion. American's AAdvantage at about 27. United's Mileage Plus at about 25. Now, one honest caveat. Those are one firm's model estimates. They are not audited numbers, and they were not produced the same way United produced its own figure back in 2020. So we are not going to line them up and claim we've measured growth. Different people, different methods, different years. The point is not that these programs got smaller. We are not measuring that here. We're not going to tell you to cancel your card or stop collecting miles. Plenty of people get real value from these programs. That's a personal calculation, and it isn't ours to make. But we'd suggest 3 changes in how you think about that number. 1. It isn't savings. It's a claim. Money holds its value while it sits. A claim is worth whatever the other side says it's worth, on the day you try to use it. Those are different things. Only one of them is safe to leave alone for years. 2. Sitting still has a cost you can't see. Nothing gets deducted. No statement shows a loss. The number stays exactly the same while what it buys gets smaller. That's the quietest kind of loss there is. It's the one people notice last. 3. You were never the only one paying. A bank or another partner may have bought the miles before you got them. That cost moved through card fees, through interest, through prices. The reward is real. It just wasn't free, and it wasn't a gift. And then the wider point. Once you know a loyalty program is a currency business, you start seeing the same shape everywhere. Store points. App credits. Wallet balances. Gift cards. Prepaid anything. Many of them share a similar trade. They get money now. You get a promise, priced later. And the one doing the pricing is the one who owes you. That's not a scam. It's a business model. Large, legal, and disclosed. But it's worth knowing which side of it you're standing on. You're not a member of a rewards program. You're holding a currency someone else prints, prices, and can devalue. And you're the last person in the chain who gets a say.